Hello everyone, this is your host on Project Drona, and today I am thinking of discussing the Sensex. So, we've heard about the Sensex a lot on TV, a lot in the news, a lot in the papers, and perhaps in our daily banking lives. Or if you're about to be bankers, you should know about it as well. So, before I go on discussing Sensex, you all must be having an idea that it is related to the stock exchanges. So I'm going to go a little back and discuss uh, what exactly stock exchanges are so that we are able to move forward in a better way. Let's start with the stock exchange. Remember in the first video on the financial systems where I created the very first model on economics, like I said it back then. So we are going to go back to it and try and understand how a stock exchange fits into that model. This was the model that we made, right? So as we see that the households and the industries are in a constant exchange of labor and cash. And when the households have excess cash, they deposited it into the banks, and the banks are in a business of lending that excess cash to businesses to expand further, which then creates another cycle because when businesses expand, they need more labor, and for that, they go to the houses again. So, this is how basically an economic cycle with these three entities works. However, let us try and fit a stock exchange into this system. Here is a stock exchange. Now, when businesses need funds, they've got two ways of getting those funds. One is by going to a bank, giving them a security, and taking a loan against that security. That security could be the land or the machinery or the assets out of the business, the building, whatever security that the bank deems appropriate. So they would offer that asset as a security to the bank, and against it, they will preferably take a loan. However, there is another way of getting funds. That other way is that they can create equity out of their businesses, which is shares, if you know what shares are, or we can go to shares in detail in another video. So out of the assets, a business creates equity. An equity is created when you dilute your business shareholding to be distributed as a right amongst the public. All right. So those paper-based securities are, in a way, a right onto the business's earnings or the business's assets itself. So if the business performs well and you hold that equity, hold those shares, you are entitled to a proportionate profit out of that business. And if it doesn't do well, it's your loss because it is the business's loss. So the business creates paper-based securities out of its assets and puts them up for sale on a stock exchange. Now, this entire process involves a lot of other things like an IPO, a book building process. We'll get into that in another video. However, basically what we need to understand here is that when a business needs money, it can either go to the bank to get cash or it can create equity out of its own assets and offer it to public. So then these securities are put up for sale on a stock exchange. Now, the households, again, who have an excess cash, probably are, here we can call them investors as well. So these guys have excess cash, and some of them are not really interested in putting it into a fixed deposit and earning, let's say, 7% or 8% of interest. They feel like if they invest into a certain business, right, in this kind of a company, they might have higher returns, which is very possible. And they have a risk appetite because, like I said, if the business fares well, you will earn earnings out of their profit. But if it doesn't, then their loss is your loss as well. This, however, is not the case with the bank. So, which makes it sort of a risky proposition. But for investors who have a risk appetite, who want a higher return, they will buy these securities from the stock exchange. So now what happens is that these securities that started off from the households went to the stock exchange. The stock exchange sells them to households and gets cash in return. And this cash goes to the businesses. So of course there are commissions involved. We'll get to that later, or you can probably imagine that, of course, these kind of businesses work for a commission. So that is basically how another institution, another financial institution comes into the picture, comes into the economy, and generates this cycle of funds. However, what you need to understand here is that the upper half of the cycle is a less risky cycle. And the lower half of the cycle that I've just shown now is the kind of the cycle that involves, higher returns, however, involves higher risk as well. So, like I talked about stock exchanges, there are some names that come to our mind. You must have heard of the Wall Street or the Indian Dalal Street. These are the two streets pretty much known to the Indians. Well, the Dalal Street houses the Bombay Stock Exchange, the biggest stock exchange in India according to its capitalization, the market capitalization. And the Wall Street, it was really in the news for a lot of during this subprime mortgage crisis and the fall of the big investment banks. The Wall Street is the home of the New York Stock Exchange. So let's come back to the Sensex. Like we discussed about stock exchanges, Sensex is an index of some funds being traded on the stock exchange. We'll come to that. So Sensex, also basically known as the BSE Sensex or the Bombay Stock Exchange Sensitive Index, in short known as the Sensex. So, the Sensex is a free float market capitalization weighted stock market index. I know a lot of stuff may have gone over your heads. However, as you will realize that we'll probably discuss it. You can dig further into it. It's not that much of a jargon. So, in fact, I'll take a couple of moments to simplify it for you guys. So, it's a free float market capitalization weighted stock market index of 30 companies that are well established and financially sound in India. And these companies are from various sectors. So it's a uniform mix. They've picked up 30 companies and their stocks that are available in the market right now, being traded at any point of time, which is what the word free float means here. Those stocks are weighted. Those stocks is the market capitalization. The current availability means free float, and weighted means according to their capital size, the volume of the stock available. They have attached weightages to it. You must have done weighted averages. It is much like that. So there is a formula involved, but we'll not get into it. So that the weighted index is calculated from those 30 companies which is called the BSE Sensitive Index or the Sensex. Well, some of the names involved in the Sensex are Bharti Airtel, ONGC, State Bank of India, Infosys, NTPC, DLF, Tata Motors, Tata Consultancy Services, and Hero Motocorp. You can dig the other names from the internet. A lot of them are the Navratnas of the Indian government. So, this Sensex, historically, the base year of the Sensex was the financial year, was the year 78,879, and the base value for it was 100 on the 1st of April 1979. So, ever since it's climbed up, and since that base year, we have reached this value that you keep hearing. It was a while ago 19,000, and then it became 21,000, and it fell down. So basically, this weighted index, as it goes up and as it goes down, it is tracking the performance of these companies over during that period of time, and it tells us about the overall situation. So that was about the Sensex. Enough that we need to know. And if you want to dig further into it, you can go over the internet and check more about it. But as bankers, I think this should be the overall gist of it. Another thing that comes to my mind right now is have you heard of the phrase bullish and bearish markets, bulls and bears? Although most of you would be knowing it, however, let me just now that we are here, we're talking about stock markets. Let me tell you about them. Bull markets are generally when the markets are performing rapidly, fast, nicely, are in an aggressive phase. The stocks are rising up when the market sentiment is very positive. So that is what we refer to bullish markets. The bull being aggressive and all. And bearish markets are when the markets are not performing aggressively, are in a stagnant phase, or the stocks are not picking up, they're sluggish. That is when we refer to as a bearish market. The bear being sluggish and all, Another image that should come to your mind is the raging bull on the Wall Street. So, yeah, that should be it. And thanks for sticking around. Thanks for watching Project Drona. This is your host signing off for now.